Personal finance is something almost everyone participates in, yet very few truly understand. Every day, ordinary people borrow money, save for emergencies, insure their health and homes, and invest for retirement. These decisions shape the quality of our lives more than almost anything else. And yet, the system we rely on to help us make those decisions is deeply flawed. In Fixed, economists John Y. Campbell and Tarun Ramadorai make a bold claim. Personal finance markets are not merely complicated or imperfect, they are systematically rigged against ordinary people. Not by accident, but by design. The system works exceptionally well for financial institutions and for a small group of highly educated, wealthy, and financially sophisticated consumers. For everyone else, it quietly extracts value through confusion, complexity, and costly mistakes. The book is not an attack on capitalism or markets themselves. Instead, it is a diagnosis of how modern personal finance has drifted away from its original purpose, helping people manage risk, smooth consumption over time, and build security, and toward a system that profits from human error. The authors argue that most people are not bad with money. Rather, they are placed in an environment that makes good decisions unusually hard, and bad decisions surprisingly easy. And because these mistakes compound over time, the consequences can be devastating: lower wealth, higher debt, reduced retirement security, and greater inequality. Part 1. The scale of the problem. The first major theme of Fixed is scope. Campbell and Ramadorai emphasize that personal finance is not a niche issue, affecting only a few careless consumers. It is a global, systemic problem that touches billions of people. In the United States alone, households hold trillions of dollars in mortgages, student loans, credit card debt, retirement accounts, insurance policies, and bank deposits. Similar patterns exist across Europe, Asia, and emerging markets. As the global middle class expands and people live longer, more individuals are forced to make complex financial decisions well into old age, often without guidance. The authors show that even small mistakes, such as choosing the wrong mortgage type, paying unnecessary fees, or failing to refinance debt, can cost tens or hundreds of thousands of dollars over a lifetime. These losses are not evenly distributed. They fall disproportionately on people with lower incomes, less education, and less access to financial advice. Importantly, the book rejects the idea that better financial education alone will solve the problem. Decades of evidence show that while education helps at the margin, it does not fundamentally change outcomes. The system itself is too complex, too opaque, and too cleverly designed to exploit behavioral biases. Why personal finance is so hard for humans. A central insight of Fixed is that personal finance is uniquely mismatched to human psychology. People are asked to make long-term decisions with uncertain outcomes, infrequent choices with irreversible consequences, trade-offs between present comfort and future security. At the same time, humans are impatient, overconfident, loss-averse, prone to procrastination, easily overwhelmed by complexity. Financial institutions understand this extremely well. Products are designed with features that exploit these tendencies: teaser rates, hidden fees, complicated contracts, and choice overload. While these practices are often legal, they systematically disadvantage consumers who lack time, expertise, or bargaining power. The authors emphasize that markets fail when one side consistently knows more than the other. In personal finance, the information gap is enormous. Banks, insurers, and asset managers employ teams of PhDs, lawyers, and data scientists. Consumers, by contrast, are expected to navigate fine print after work, late at night, under stress. This imbalance is not accidental, it is profitable. How the system became fixed. Campbell and Ramadorai trace how personal finance markets evolved into their current state. Historically, many financial products were simple and heavily regulated. Over time, deregulation, innovation, and competition increased complexity. While this benefited sophisticated consumers, it created opportunities for exploitation. The authors describe a pattern they call shrouding, the deliberate hiding of true costs in complex pricing structures. For example, low advertised interest rates paired with high fees, free services subsidized by penalties or cross-selling, retirement products with opaque expense ratios. Because only a minority of consumers fully understand these structures, firms compete not by offering the best value, but by attracting naive customers while avoiding price competition on hidden margins. This leads to a perverse equilibrium, markets that appear competitive, but deliver poor outcomes for most participants. Credit, borrowing in a rigged game. One of the most damaging areas of personal finance is consumer credit. The book examines credit cards, payday loans, auto loans, and student debt. The authors show how credit products are often structured to encourage minimum payments, penalize late or missed payments heavily, reward revolving debt. Consumers frequently underestimate how long it will take to repay balances and how much interest they will ultimately pay. Meanwhile, lenders profit most from customers who struggle but do not default. In student loans, complexity and optimism bias lead borrowers to overestimate future earnings while underestimating repayment burdens. In mortgages, poorly understood terms can expose households to catastrophic risk during economic downturns. The result is a system where debt becomes a trap rather than a tool. Saving and investing. Why the odds are uneven. Saving and investing should, in theory, reward patience and discipline. In practice, outcomes depend heavily on fees, product choice, and timing, areas where financial firms hold the advantage. The authors highlight how high-fee mutual funds underperform low-cost alternatives. Conflicted financial advice steers clients toward inferior products. Complex retirement plans confuse participants. Even small annual fees compound into massive losses over decades. Yet many investors remain unaware of what they are paying or how it affects long-term returns. The book also explores how market timing mistakes, driven by fear and overconfidence, reduce returns for ordinary investors, while institutional players profit from increased trading volume. Insurance, protection or extraction. Insurance is meant to protect people from catastrophic risk, but many insurance markets have become riddled with complexity, exclusions, and pricing strategies that disadvantage consumers. The authors describe how consumers over-insure against small risks, under-insure against large, rare events, misunderstand coverage details. Behavioral biases and opaque contracts lead people to buy policies that offer poor value, while believing they are protected. In some cases, people turn to informal or unregulated insurance arrangements, exposing themselves to even greater risk. Opting out when people abandon the system. A striking observation in Fixed is that some people choose to exit the formal financial system altogether. Distrust, past negative experiences, and perceived unfairness push individuals toward cash-only living, informal lending, or unregulated financial products. While this may seem empowering, the authors argue it often makes things worse. Informal systems lack consumer protections and can amplify inequality and insecurity. Why inequality widens. One of the book's most important conclusions is that personal finance is a major engine of inequality. Wealthy, educated individuals pay lower fees, borrow at better rates, receive better advice, exploit tax advantages. Meanwhile, less advantaged consumers pay more for basic services, make more costly mistakes, bear greater risk. Over time, these differences compound, widening the wealth gap even when incomes are similar. Part 2. How to fix a broken system. Despite the grim diagnosis, Fixed is ultimately an optimistic book. Campbell and Ramadorai believe the system can be redesigned to work better for ordinary people. They propose a framework built on 3 pillars: better market design, smarter regulation, technology aligned with consumer welfare, simplification and standardization. The authors argue for reducing unnecessary complexity in financial products, standardized contracts, clearer disclosures, and default options can dramatically improve outcomes without limiting choice. The goal is not to eliminate innovation, but to ensure that innovation benefits consumers, not just providers. Regulation that targets incentives. Rather than relying solely on disclosure, regulators should focus on aligning incentives. This includes banning exploitative fee structures, reducing conflicts of interest in financial advice, protecting consumers from predatory products. Good regulation, the authors argue, does not stifle markets, it makes them function properly. Harnessing technology for good. Technology has the potential to balance power in personal finance, automated advice, low-cost investment platforms, and real-time transparency can help consumers make better decisions. However, technology must be guided by policy. Left unchecked, it can also be used to micro-target and exploit vulnerable consumers. The role of government. Governments already play a central role in personal finance through tax policy, retirement systems, and social insurance. The authors argue for expanding and modernizing these roles to provide safe default savings options, basic insurance protections, consumer-focused financial infrastructure, a system worth trusting. In the final chapters, Campbell and Ramadorai return to the core question of trust. A financial system that people do not trust cannot function well. When individuals believe the system is rigged, they disengage, to their own detriment and to society's. Fixed is ultimately a call to action, to redesign personal finance so that ordinary people are not set up to fail, but supported in making decisions that lead to security, dignity, and opportunity. Final takeaway. The central message of Fixed is clear. Personal finance is not broken because people are irrational. It is broken because the system profits from their mistakes. Fixing it requires rethinking how markets are designed, how regulation is applied, and how technology is used. If done correctly, personal finance can once again serve its original purpose, helping people live better lives.